The big question here came up on Friday are those jobs numbers. It really was so far away and above what was expected. What do you make of those numbers? Where are we in this economy, and how can it keep doing what it's doing?
Look, we've got something of an Energizer bunny economy. The economy keeps moving right along. It's not only that we got a very strong employment number this month, we had upwards revisions for the last 2 months. If anything, it looks like job growth is accelerating. For the moment, this is great news. We got an economy that looks very strong, and the wage inflation numbers looked very much under control. For the medium term, very complex picture that the Fed has to read. Tight and substantially tightening labor markets, combined with significant labor unrest, combined with significant uncertainty about commodity prices. And even though it doesn't show up in the inflation statistics explicitly, people feel when interest rates are going up, when mortgage rates are approaching 8%, like their cost of living is rising. So very challenging environment going forward. These are good numbers, and you got to recognize that these are good numbers, but I can't say that they give anything like assurance of soft landing. And I think the risks of hard landing are very much as real as they were, and perhaps the fact that the plane is flying even faster than we thought makes the hard landing at some point risk look a little greater.
So Larry, why is the plane at this point flying this fast? I mean, an awful lot of people thought once you raise the rates as much as the Fed did, as quickly as it did, it would slow things down. Sure doesn't look like that message is getting through, for example, to corporate leadership that's hiring as fast as they can.
David, that economists will be studying that for a long time. One of the things I've talked about on your show is that interest rates may be less restrictive than they used to be. When people don't sell houses because they're locked in with low mortgages, house prices go up, and that makes people feel wealthier. When the government's got as much debt as it does and interest rates go up, that's more money in people's pockets, and they spend some of it. When capital that people are purchasing is a new AI system, rather than building a new factory, it's all shorter duration and less interest sensitive. So we may be living in a world where the interest rate is less of a tool for guiding the economy than it used to be. And that means when things need to be cooled off, interest rates are going to have to be more volatile than they have been in the past. That's one important part of it. And the other important part of it is what's happening with the budget deficit and what's happening with the government's fiscal position. Even though we've got a booming economy, the deficit as a share of GDP, once you take out special factors, will just about double this year, will rise by more than 3% of GDP. That's been a big push forward to the economy. And frankly, our financial authorities haven't done what has been done by corporate treasurers and by smart households. Over the last several years, when the private sector was terming out its debt, we did more terming in with QE and what the Treasury has done than we've done terming out of the debt. And that means that we've got a wall of higher and higher debt finance that is ahead of us. So I think it's a combination of the changing impact of interest rates and the fiscal expansion that explains where we are. And that's why I don't think interest rates are likely to come down quite as much, and haven't for a long time thought interest rates were going to come down as much as the market did. The market's revised its views substantially. I wouldn't be surprised if the market revises its view a little more.
Well, so Larry, let's go to where the market is right now, because we did see real turmoil in the bond markets. We saw yields really go up. You, 2 or 3 weeks ago on this program, talked about a 4.75% on the 10-year, and at the time it seemed like an awfully high number. Now, if anything, maybe you were not fast enough in making the call, given where we are this week. Is that because of supply and demand, because of the deficit that you're talking about, and how much the supply is exceeding the demand right now?
I think it's half underlying reality of the strong economy and what's going to be necessary to keep the economy in balance, what Fed watchers call R star, and everybody's just I've been warning for quite some time now, revising upwards their view of R star. I think that's half the story, and I think the other half of the story is people thinking that there's just a big issuance of debt ahead, and there's less willingness to hold U.S. long-term debt. Given rising rates in Japan, that source of demand may fall off. Who knows what's going to happen with China as a source of demand for U.S. debt. The changes that all the banks are making to make sure that they're not the next SVB caught with a lot of long-term bonds, that's reducing holdings of long-term bonds. So if you've got more supply and less demand, that should be less more supply and less demand. That's gotta have a big effect on price.